Well, thank you, Ray. I appreciate that intro. And my name is Todd Shaffer. I'm the manager of research. And listening to Dr. DeLito's intro, at first I'm struck what a treasure he is, right? Anytime I can have an opportunity to hear him speak, I'll take it. But it also makes me think about the origins of my investing. I started investing in the 70s, about the time Dr. DeLito was starting to think about VectorVest and its methodologies. I was out there as an individual investor trying to figure it out myself. And I did all the things you're supposed to do. I subscribed to Money Magazine and Kiplinger's and read the Wall Street Journal, right? Did all those things and moderate success. So I eventually started turning and investing with mutual funds. And that worked okay until I came to the tech bubble burst, right, in 2000. And all of a sudden I thought, well, wait a minute. The experts didn't necessarily fare very well in this bubble, but I didn't really have anywhere else to go. Well, I've been with VectorVest for 15 years now, and if you do the math, that means I started with VectorVest in 2007. What a divine intervention, right? 2007, I've been in the seat for a couple months now in customer support. Dr. DeLito writes his famous essay from November that says, this is the big one. This is not the time to be buying stocks, even though they're going to be telling you to do that, right? And we talked about contra ETFs. So not only did VectorVest save my bacon, but I actually made money in that downdraft, in that correction, investing in contra ETFs. So I was hooked. And so here I am, all these many years later, still a devotee of the VectorVest system. So this talk is a foundational talk expanding on the idea of the VectorVest philosophy. Because a philosophy is a structured way of thinking about the principles and the truth of any given subject matter, and of course, in this case, we're talking about the markets. That structure also forms for us the framework of a filtering system to help us identify or separate truth from fiction. And we all know the industry pumps a lot of fiction. That structure also informs a process that we can use to approach the markets that also isn't just a philosophical approach, but is confirmed by facts and data, right? A very important integral part of the VectorVest approach and the system. So Dr. DeLito mentioned his book, so you know how to get it, but I really encourage you to read it, because in that book, not only is he expressing the philosophies, but he also is sharing the mathematical expression of those philosophies. And those, of course, form the basis of the algorithms that are within the program. So he's made it a very approachable book, so I encourage you to read it. I've read it multiple times, as many of us have, because I learn something new every time. Sometimes I relearn things that I forgot that I had learned before. So I encourage you to pick up that book. That being said, let's move forward and then explore more deeply the VectorVest philosophy. VectorVest believes every investor should know what a stock is really worth, how safe it is, and when you should be buying, selling, or holding it. These three questions form the basis of our VST system of analysis, our core system of stock analysis that you'll see in the VectorVest system every day. That first question of what is a stock really worth is a question of valuation. So we look at valuation from two perspectives. First, the intrinsic value of the stock. Every day we publish a dollar and cent valuation for every stock in our database, and it's updated in real time. So that valuation gives you a hard number with which to compare with the price that's currently being traded in the market. So now you have actionable information that you can use to help gauge whether or not that stock is undervalued, fairly valued, or overvalued. If it's undervalued, well, right, that's the preferred status, right? If I can get $1 worth of stock for 70 cents, Well, I like that. It's on sale. I'm getting a bargain. It puts another piece of the probability picture in my favor, particularly if the stock has strong fundamentals, if it's a good company. But what if it isn't? There are some stocks out there that are undervalued for a reason. They have no fundamental strength. People just don't want to be in that stock. We call that a value trap. So you can't just look at the valuation itself and say, oh, it's a good investment because it's undervalued. No, you need more information. You need the fundamental analysis that VectorVest, of course, provides. So those are undervalued stocks. You can also have a fully valued stock. Well, a fully valued stock, you're not getting a discount, but you're also not paying a premium either. So you're paying full retail for the stock, which, depending on market conditions and the stock in question, may be fine. The third possibility is that the stock is overvalued. Well, if the stock is overvalued, we don't like paying more for something more than it's worth, particularly if the stock doesn't have good fundamentals. So why would people overpay for a stock that has weak fundamentals? Well, beyond hype, they might be speculating on the future prospects of the company that haven't been demonstrated yet in fundamental performance. So for instance, maybe it's an innovative company that has a new technology or a new process that's a real game changer. Maybe it's a company that is due for an FDA approval or a patent approval, or maybe they're going to win a court case perhaps. But ultimately, investors are speculating on some non-fundamentals based event happening that will greatly change the prospects for that company. Well, what if the company does have good fundamentals? Now I have an overpriced company that has strong fundamentals that maybe warrant paying a premium to be in that stock. We call these stocks glamour stocks, particularly if the stock is a perennial performer, right? Just year in, year out, they knock the cover off the ball. People are happy to pay a premium to hitch their cart to that horse. So those are glamour stocks. There's a third possibility, though, that the market broadly is overvalued. So particularly at the end of long bull runs, money's been flowing into the market chasing the same relatively fixed number of stocks, inflating the price of the market broadly. It's very difficult in that kind of market condition to find undervalued stocks that have strong fundamentals because the money's already been chasing them. So if you decide that you're only going to buy stocks when they're undervalued, you may be sitting on your hands for quite some time because bull markets can last for years. Do you really want to sit out the market for years? So it puts us in the situation where if you want to make money, you need to invest. And so there may be times when if we want to play, we're just going to pay. Otherwise, you're left with the choice of not participating or going elsewhere with your investments while the market is in that overvalued state. The key here is that you now have a metric to understand all of those situations. And now you can make a decision, an informed decision, on how you want to play that market condition and how to best align that trade or that investment with your objectives. It's information that you can use that's actionable that you can't get anywhere else. All right, let's look at the second way we look at valuation. Because as investors, we are forward-looking investors, right? We're looking to the future performance. And so we have an analysis that we do that looks at the upside potential of that stock as part of the valuation model. So every day we measure and map the upside potential for every stock in the database and report that information to you, again, to help you make informed decisions about the stocks that you're considering investing in. Now that was the first question, what's a stock really worth? Let's talk about safety, because it may have great upside potential, but I may not be really interested in taking on a lot of risk to attain that potential, right? So is this stock a Maalox moment waiting to happen, or is this a sleep at night stock? Well, every day VectorVest measures and maps the safety of every stock in the database, and again reports that to our subscribers to help you make a better informed decision. Our third question was, when should I be buying, selling, or holding that stock? VectorVest assigns a buy, sell, or hold rating to every stock in the database every day. The stock's performance is what drives that rating. And it's based on rules. No gut hunches, no narratives, right? No funny business. It's all driven by data. So in that system, we give preference to stocks that have fundamental strength that are rising in price. Those are the stocks that in our VST system, value, safety, and timing or price trend. Stocks that have strong VST scores are stocks that have those attributes. And we like to buy rising stocks because we don't like to buy falling stocks. And the problem with buying falling stocks, even though the industry will tell you, well, you're getting a better price. Well, you are, but if you buy the stock while it's in downtrend, you don't know how far down is. So we say instead of buying the stock while it's falling, let's wait for that to stop. Wait for the stock to start rising again. Now that's a better time to enter that position. So that VST system of finding stocks that have fundamental strength that are in rising price patterns leads us to our mantra. VectorVest believes in buying safe, undervalued stocks rising in price in rising markets. We also believe in selling falling stocks in falling markets. So let's unpack this a little bit. The VST system gets us to the buying safe, undervalued stocks rising in price. But we've added a little bit of information here in that we want to buy those stocks when the broad market is rising. And why do we want to do that? Well, we want to do that because market direction is actually the most important consideration when you're buying stocks. Market direction has more to do with your trading success than stock selection does. And if you think about it, when the broad market is rising, by definition, the majority of the stocks in that market must be rising, the good and the bad. So the probabilities of the stock that you selected rising are much improved. Conversely, when the market's falling, the majority of the stocks in that market must be falling, the good and the bad. So you may have a great stock, but simply because the market's pulling back, and I just asked you to think about recent history, good stocks get crushed just like any other stock. They may be more resilient, but still stocks are broadly falling when the broad market is falling. So doesn't it make sense that we would buy our stocks that we hope will go up when the market's rising instead of buying into a falling market? VectorVest, again, identifies with our market timing system when those conditions are present, when the market's rising. Again, actionable information that you can use to make better investing decisions. Now, the inverse is also applicable here, right? We also believe in selling falling stocks in falling markets. And here we're simply looking for the mirror image, right? So if I'm going to sell stocks, then I want to sell weak stocks. I want to sell stocks that are overvalued, have weak fundamentals, that are in downtrends, and sell those stocks when the market's falling. There's one last inference here, and I want to make sure that you got it. There are times that it's not a good idea to be buying stocks, right? If we're going to be buying stocks when the market's rising, if it's not rising, we shouldn't be buying. When's the last time you heard somebody in the financial media say, you know what, market's kind of stinky right now, let's not buy anything? No, you turn on CNBC and there's this panel that has the bulls over here, the bears over here. They argue it out for 10 minutes. At the end of the segment, the moderator comes back in and says, so what are you buying? Right? So to Dr. DeLito's point, it's always buy, 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 buy. Well, VectorVest says, well, no, there are some times when it's more prudent to just sit in cash, right? Cash is a position. Hold your money back. Don't put it at risk because conditions are not favorable for you to be successful. What a concept. All right, so that is our belief in buying safe, undervalued stocks in rising markets. what's the biggest mover of that market direction? Well, there's a couple things. First of all, at a very elementary level, it's people buying and selling stocks with volume driving prices, right? Okay, yeah, I get it. But when you go to the next level, there are actually macroeconomic forces that are driving those decisions. And as we go through this will probably ring a bell for you. So the first piece is earnings is the engine driving this bus. Now, from a market standpoint, when earnings are rising, market prices rise. And this is very easy to demonstrate if we go into the program. So in the program now, I'm going to go to our graphing tab, and I'm going to open a market climate graph. So the market climate is where we house all of the macroeconomic data in the program. That data, by the way, feeds the algorithms within the program. I'm going to put on this graph the S&P index and the 50-day moving average of earnings for the component stocks of the S&P index. And I'm going to flip that around so that I get the S&P on the top graph. So first, a word about earnings. So VectorVest calculates earnings or measures earnings to include earnings forecasts by the industry analysts. And we include forecasts in our algorithm because investing is a forward-looking endeavor. So we want to keep track of the future prospects of the stock. So we include those future earnings prognostications by industry analysts in our number. But what I want to do is take this time frame and I want to stretch us out to something more like 20 years. I don't have enough mouse pad here. All right, now that's a little washed for me, but I'm going to hope that you can see it. And the key here is I want you to notice the correlation between the earnings performance and the market's price performance. The market is represented by the S&P 500. So it shouldn't take too much convincing for you to see the high correlation between the two. So we can easily demonstrate that earnings is driving or helps drive market price. Let me see if I can get back to our slide. So what about the inflation and interest rate aspects of our philosophy statement here? When the economy is strengthening, right, when the broad economy is strengthening, earnings go up, inflation goes up, interest rates go up. When the economy is falling, earnings, inflation, and interest rates fall. So when the economy is strengthening, earnings improve. That typically drives up stock prices. But also as the economy improves, people's buying power and demand increase. That gives companies pricing power, and so prices rise in that scenario. And so inflation is rising along with those earnings. The central bank is charged with monitoring and managing the economy so that it doesn't overheat and it doesn't go into recession. So they establish a benchmark, a target rate, if you will, for what they want inflation to be. And when the economy gets overheated, goes above that range, they step in to slow down the economy by raising interest rates. When they do that, they actually kind of plant the seeds of their own demise, right? And that by raising those interest rates, it slows the economy, and hopefully it slows it just a little bit. Earnings come down a little bit. They slow, but don't actually start falling. Inflation, right, that's the goal, slow it down. But it's not an exact science. And so sometimes we overshoot, And the raising of those interest rates actually turns the economy into contraction. Earnings actually start to fall. Inflation falls. And so the Fed, in order to stop the fall, turns from tightening, hawkish behavior, into dovish behavior, and they start stimulating. And so we have this cycle of economic factors driving earnings, driving stock prices, and inflation, the Fed stepping in to manage that whole process. So the Fed is a pretty heavy hitter in that nexus. So VectorVest closely tracks earnings, inflation, and interest rates in the economy because of their impact that they're going to have on markets. We do that in the climate section of the program. So hopefully off I go to the program again. Clay, if you can drive that for me, since I don't see an icon. And this time I'm off to the Views. Now the Views is our daily newsletter, printed Monday through Thursdays in abbreviated format, where we just give you timing and strategy guidance on a daily basis. But on Fridays, and I'm going to go back to last Friday, because we haven't published yet today. On Fridays, we have a much more extensive publication. Let me get rid of the toolbar here. And so you see all the chapters that we have here in the Views. Well, I'm going to go down to the climate section. And we start with narrative about the macro indicators and what's happened this past week. But if I scroll down, you'll see a table where we identify those macro indicators and their current trends. So you see, particularly in the context of our conversation, we're tracking earnings, we're tracking inflation, and interest rates. You see the current level in our table, and then you see a weekly column for each of the indicators, and the values that you're seeing expressed in those cells are on a 0 to 2 scale. And this is a convention that we use in VectorVest, again, because we're trying to convey information, not just overwhelm you with numbers. So on a 0 to 2 scale, 1 is neutral. Values above 1 are favorable, values below 1 are unfavorable, from the context of an investor. So with inflation, with CPI inflation currently at 8.3%, right, it's unfavorable, so it's below 1, but notice that the score is actually improving. So inflation at 8.3%, while it's still high, is pulling back from its higher values, so it's getting less bad. That's another way of saying improving, I suppose. Interest rates, however, right, are doing what? Falling. They're getting worse. So a situation just from the raw numbers where you can see that inflation is moderating, interest rates, however, are still cooking, still rising. We take this information, and you can see if we scroll back up to the narrative that we had above, after we talk about the changes to those numbers from the week, you see narrative that says we currently have a case 3 bull market scenario in which earnings interest rates are rising while inflation is falling. And for the uninitiated, you're thinking, case 3 bull market, what is that? Well, fear not, my friend. We give you the reference. Let's jump to the Views to give you some more information. We're going to go back to an essay that Dr. DeLito wrote back on March 21st of '03. So let's take our Wayback Machines. I click on the year, I click the year again, and I get a date range. So now, a little faster to get back to '03. March, where did you go? 21st. And I need to go, because it was in his essay, I need to go back to the overview section to find that essay. And in that essay is a thing we call the truth chart. So let me set it up. First of all, you can see that we have earnings, inflation, and interest rate columns, right, are three factors. And each of those factors have two conditions. They can be either up or they can be down. We also indicate their effect on prices. So we have the possible combinations of the indicators, and we've given a case number to each of those situations. So we have 4 up situations and 4 down situations for earnings, right? By the way, 4 up situations for price and 4 down situations for price. Do you notice how they correlate with earnings performance? That shouldn't surprise you based on the conversation we've just been having. So the setup here is the bull market begins as a transition out of the down market, right? So the market is falling, earnings are down, inflation is up, interest rates are down, prices are down. The bull market ends when, lo and behold, somebody makes money, right? Somebody actually has a profit and they have earnings power that comes with generating that profit. So the bull market begins. The Fed, that's been dovish, now turns back, pulls back from stimulating. The economy and the markets normalize, and we go into the Goldilocks scenario where the bull market thrives because earnings are up and inflation and interest rates are not. Right? So very little drag on the economy and on companies' earnings. We're going to skip case 3 right now. That's where we are. We see that it rarely happens. Case 4 is what more typically happens is as the economy heats up, inflation rears its ugly little head, the Fed tightens, and they start raising interest rates. We're still in uptrend, however. Prices are still up because earnings are still up, but you can see the writing on the wall that the Fed has stepped in and that's going to have impact. So how do we get to case 3? Well, we have a case 3 that inflation has actually started to slow, but the Fed has not. Right? So it rarely happens because the Fed rarely tightens into a slowing economy. But that's where we are now because we got a little bit out of hand. We're behind the 8 ball and we're trying to pull back inflation from that 8% threshold back to their target, which we'll see if they make some adjustments. Right? But if they think they want to be in that 2% range, there's a way to go. So in stage 4, we call this climbing the wall of worry. Right? We're in the late stages of the bull market, which can last for quite some time, by the way. But we're dancing, I was going to say dancing with the devil. That's not the right way to say it. But we're approaching the top of the market, right? So everybody's getting nervous about how much further can this go. And we're all very sensitive to any kind of news that companies say, oh, by the way, we didn't make money or we don't expect to make money into next quarter. That's kind of the telltale sign we're looking for. And FedEx was last week, came out with very weak guidance, right? And the market got crushed. So one company does not an economy make, right? But as the bear market begins, inflation is high, the Fed is tightening, prices are moving down. As it develops, right, the market continues to slow, bear market prevails, we're easing now, inflation is falling, interest rates are coming down because we're trying to stimulate, but the market doesn't care, we just keep moving lower until we get to our bottoming threshold and we just reset and do it all over again. Rinse and repeat, right? That's the market cycle. So where are we now? Right? Remember, one of our theses here is you can come up with a narrative, but we want to come back and check that narrative with the facts. So let's take a look at where we are now. If I come back to my climate graph, and instead of looking at 20 years, let's just look at a year. Where are we now? Well, the market peaked, the S&P peaked in January, the broad market peaked, our VVC peaked in November. What was happening in December? Well, remember we were having this argument about whether or not inflation was transitory or sticky. Well, in December, the Fed decided, well, at 9%, it looks like it's sticky. So we're going to start defending. Right? We're going to start raising interest rates. The market's been to this rodeo before. The market starts saying, well, I'm not fighting the Fed. Prices start to drop as we start repricing in this new environment of higher inflation and interest rates. What happened to the company's ability to make money? Well, that didn't change. The companies are still improving their earnings, at least the companies that are the component of the S&P 500. They're still making money. Earnings are still moving higher, but at a slower rate. Notice the change in slope from this part of the graph to this part of the graph. So earnings start slowing, and now we've actually started pulling back. But how would you characterize that trend? Right, we're off the highs, but are we dropping? Well, no, we're actually kind of hanging in there. Right? So depending on how you define the trend, from a one-year basis or longer, we're still up, but weakening. If you wanted to measure the trend in 2 months, you'd have to say we're down. But we analyze the trend using our earnings trend indicator tool, again on that 0 to 2 scale. And let me back this up a little bit. As long as the earnings trend indicator is above 1, then that trend analysis tells us that we're still in uptrend. A weakening uptrend, to be sure, as the slope is pulling back, but still an uptrend. And so that's how we're in a case 3 bull scenario, because the trend has not yet turned to down. So what has to happen for that trend to cross from above 1 to below 1? Well, the earnings have to actually start falling. So keep an eye on earnings, and that's why particularly this earnings reporting season, and probably next quarters as well, are going to be very important for us to see who wins this foot race. Are companies able to manage their way through this economy? Do we get our soft landing? Or does the market continue, the economy continue to deteriorate and throw the market into bear trend? But right now we see weakness developing, right? So we ought to be changing strategically our outlook to being something much more cautious. Our market timing signals are the tactical tools we use to say, oh, hey, wait a minute. The market is moving against me. So those signals move much more quickly than does our trend analysis, right? So think of the earnings trend analysis, the case scenarios as strategic, the market timing signals as tactical. So that's how we use data to analyze market conditions and map our way through the different economies and the different cycling of the economies. Right? It's earnings, inflation, and interest rates that are driving the system. Well, this is true at the stock level too, right? Stocks improve their value. Companies improve their value by making money, by making more and more money over time, right? So when their earnings improve, their valuation goes up, and that typically commands a higher price. Inflation and interest rates, while they have macro impact, they also have local impact in the company too. When inflation and interest rates are high and rising, $1 of earnings that you made when inflation is with 2% is much different than $1 of earnings you made when it's at 9%. So companies struggle more when you're in that high inflation and interest rate environment because their costs are going up, but so are the costs of their customers, right? So their business slows in that kind of environment. So we want to look and keep in mind both levels, what's going on in the economy and how is it impacting the individual stocks that we're investing in. Well, of course, part of the theme of this presentation today is that VectorVest measures and maps all of this for us every day, intraday. So it gives us actionable information that we can use to make better investing decisions. And we'll next turn the corner so that we can see how that those analysis tools apply at the stock level. All right, but first let's go back to Ray and we'll introduce our next speaker.